History. TUI taps state aid. The travel provider sees a 98.5% slump in revenue for the quarter as Germany injects an extra 1.2 billion into the travel company. Plus, no compromise. Democrats and Republicans point the finger at each other as the stimulus debate gives way to electioneering. The two sides remain trillions apart. Matt?
All right, so we are seeing European futures that are down this morning. Worse in London, bigger drops in London on FTSE futures than we see in DAX futures in Frankfurt. The live cash open now starts to trade. Let's take a look at the global macro movers screen on the Bloomberg. It shows you a slew of risk assets. In the far left-hand column there, you see equity indexes, and as they open up live, the boxes will pop up. Red for drops, green for gains, and gray means it's not doing a lot of movement. There you see in gray the CSI 300. Just ignore that one. Focus in on the European equity indexes, and you'll see that they are opening down. The FTSE down almost, 8 or 9/10%. The OMX in Stockholm down 4/10%. The CAC 40 in Paris down 0.3%. So European markets, for the most part, opening lower. That's even after the S&P 500 in New York tipped over its highest ever closing level before finishing just a few points shy of the mark. Gold has held above $1,900 as CPI data comes out from Spain and Germany. We saw also more consumer inflation in the U.S. than had been anticipated yesterday, but the German data wasn't a surprise, down about 0.5% for CPI month over month, and only 0.1% for CPI year over year. In terms of the Spanish numbers, we're just getting those breaking right now. July CPI was down 0.9% in line with the estimates month over month, and 0.6% in line with the estimates year over year. Joining us to talk about all this and much, much more is Sarah Hewen, Standard Chartered Bank Chief Economist for the Americas and Europe. And Sarah, this has been a popular topic of debate, especially over the last few days. But of course, inflation always is, right? Because so many consumers think that it's underreported, and there's always a discussion about what's in your basket. But what do you think about inflation rearing its ugly head now that it's more of a problem for, more of a tail risk for market assets?
Yeah, I mean, it is a vital question because interest rates so low, central banks are acting as if inflation is going to be low for a long time. They're certainly planning to keep rates very low. So if we were to see a spike, a durable spike in inflation, then that could have quite severe market consequences. And yesterday's US data were very much on an upside surprise. And also across the board, you had communications, used cars, medical equipment, insurance. All of those features contributed to higher inflation. So we can't say that it was just down to one specific factor. I think if we take a step back and look at the environment over the next couple of years, we're going to be in a situation of spare capacity still, underemployment, high unemployment, economies operating below trend, and companies closing down. That suggests to us that inflation pressures should overall stay low, although there is the risk that you get a supply side cost shock, which could at least temporarily take inflation a little bit higher. Overall, though, we still see inflation staying low in this weak economic environment.
Yeah, Sarah, good morning. Interesting points, and obviously important to keep across the underlying economics of this and the weakness in economies. I suppose also the inflation that we measure, that statistical agencies measure, that you would hope would be the inflation you would feel. But given the big changes in consumption patterns we've seen because of lockdown, you do wonder whether the inflation that we will talk about over coming weeks and months will actually reflect the reality on the ground.
Yes, I mean, the way that people are spending the money has certainly changed, and that's changed quite significantly with a real pullback in spending on accommodation services, eating out, restaurants, and going out for entertainment, to spending much more on staples, of course, but also on streaming and virtual entertainment. So the basket of goods, that generally tends to be changed on an annual basis or revisited on an annual basis, and so may not be reflecting how people are spending their money at the moment. But I think this is an ongoing issue. People do tend to say that their experience of inflation is higher than the figures are saying, and that often relates to the fact that their day-to-day spending is maybe have higher inflation, but actually the big item, the big ticket goods are not rising in price.
Nonetheless, gold has been on a tear. Okay, it had a huge drop in one session this week, but we're still seeing it $1,930 a troy ounce. That typically indicates that investors are worried inflation is on its way, as well as, you know, sort of Eco 101 leads you to believe that when the central banks turn on the printing presses and just leave them running, you know, blowing up their balance sheets, that's also got to bring inflation. Are those two indicators flawed?
Well, I mean, gold certainly does indicate that some investors are worried about inflation. It also indicates that returns are so low in other assets, of course. In terms of the printing presses being turned on, well, we've had that situation since the global financial crisis, and going back 10 years now, there were real concerns that would result in higher inflation. We haven't seen that coming through. Now, some of the structural factors, the globalization, for example, that were really significant in holding inflation down in years gone by, that is coming to an end. We're seeing deglobalization to an extent, but there are still other structural factors, demographics, for example, technological improvements, which ought to mean that we have a cap on inflation, that inflation pressures are held down. So it's true, people's personal experiences tend to show to them that inflation is higher than reported, but I think we can still trust what the statistics offices are saying.
Sarah, thanks very much. Sarah Hewen, stay with us. Standard Chartered Bank Chief Economist for Americas and Europe. Coming up on the programme, the S&P 500 is on the cusp of all-time highs, but if investors are counting on stimulus, they may be disappointed. We'll discuss the stalemate in Washington. What do you expect? This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. Right now, 10 minutes into the session, and we're seeing really little change on the DAX right now. The CAC 40 off 0.2% in Paris, and the FTSE down almost 1% in London. Drop of almost 60 points to 62.23. Let's get the Bloomberg Business Flash. Today's top corporate stories from the Bloomberg terminal. For that, we go to London and Laura Wright. Laura?
Thanks, Matt. Deutsche Telekom has raised its forecast and reported profit that beat estimates. That's as T-Mobile's purchase of Sprint bolstered the parent company's finances. But the picture was more mixed in the telecom firm's home market. Mobile service revenue dropped over 1%, largely thanks to lower roaming fees due to the pandemic. Carlsberg is forecasting a slump in earnings this year. That's as the coronavirus dents beer consumption in bars and restaurants. Operating profit will decline up to 15%. The brewer already scrapped its guidance earlier in the year. Rivals AB InBev and Heineken both also reported a sharp drop in first half earnings. Wirecard is losing its place in Germany's benchmark DAX index. It comes after a consultation which favored the immediate removal of bankrupt companies from the index rather than waiting for the quarterly review. Wirecard's successor will be announced on August 19th. The changes will take effect from the 24th. That's your Bloomberg Business Flash. Matt, Anna.
Laura, thanks very much. Laura Wright here in London. Now, over on Capitol Hill, the election could further stall the virus relief package until September. Republicans and Democrats are gearing up for party conventions without any current plans to continue talks. That is despite warnings from economists that a delay will further hamper the economy. Both sides accuse the other of not compromising. House Speaker Nancy Pelosi says Democrats will come down $1 trillion if the administration will raise its ceiling by the same amount. So we're still seeking compromise then from the U.S. fiscal side. Sarah Hewen, Standard Chartered Bank Chief Economist for Americas and Europe, is still with us. And Sarah, what gives you confidence that some sort of deal will be done here, and over what time horizon?
We do have some confidence that a deal will be done because the alternative doesn't really bear thinking about. The economy clearly needs that additional fiscal support. We're starting to see a flattening out of some of the surveys, at least more recently, partly reflecting the wave of the virus in the southern and western states. Now, the coronavirus it seems to be leveling out, but we still see a pretty significant impact across the country. And a fiscal package probably of at least $1.5 trillion would be needed to ensure that the momentum that we have seen in economic activity continues. And we're very well aware of the areas where there is particular concern on unemployment benefits. Those the enhanced benefits have already run out. We know that state and local government revenues are down sharply. Additional funding is required there. It is really very important. The politics, though, as you indicated earlier, suggests that it's not going to be happening anytime soon. And, our concern is that we may get through September without any particular resolution and eventually we do get a deal, but late in September.
When you look at the situation, how the situation in Europe compares, Sarah, is there a need for a lot more fiscal support here as well?
Yeah, absolutely. It's clear that the US has done a lot. The US has been ahead of many European countries, and the response in Europe has been quite piecemeal. So you've had countries like Germany that have really devoted substantial public resources to supporting the economy. Italy belatedly, France less so, Spain less indeed. And I think that that's reflected in the second quarter GDP data, where Spain was particularly hard hit, Germany much less so. The good news is that EU have agreed on a recovery fund, and the good news is also that looks likely to come through sooner rather than later. We were worried that although there is a substantial amount of funding available, that it might not be released until late next year. But there is a sort of momentum behind releasing some of that funding early, and that will provide support. In addition, you have 100 billion euros worth of funding for job retention schemes, and that's been a big success story in Europe, where we see the unemployment rate really still relatively low by comparison with the US.
Are you concerned at all about the amount of fiscal support that will be available in the UK, Sarah, then, given what we've said there about the importance of continuing fiscal support in the US and in Europe? If you put together support for people in work and also support for people out of work, do you have concerns around the UK?
I mean, for the UK, the question is when do we get a budget? What is in that budget? The mood just a few weeks ago was to look to, I think, start to raise revenues, as well as providing support, but also dialing back some of the support for the unemployed. And with the data still relatively subdued, concerns growing about a second wave that we see on the European continent, then the question for the government is, do they need to extend the program of support for the unemployed? Do they need to delay any tax hikes that they obviously would like to start to impose as soon as conditions allow? So I think that there is a clear need for more fiscal support, but governments also have one eye on the overall debt levels and how far this is going to be sustainable.
All right, Sarah, thanks so much for joining us this morning. Sarah Hewen there, Standard Chartered Bank Chief Economist for Americas and Europe. She's going to be continuing the conversation with Anna and myself on Bloomberg Radio at 9 a.m. UK time. So in just about 45 minutes, you can tune in on London DAB if you're in the city. Otherwise, you can just Google Bloomberg Radio, and it's pretty easy to find. Coming up, Boston Fed President Eric Rosengren warns America's overeagerness to reopen the economy before containing the virus has backfired. More from that conversation next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open, and we are 20 minutes into the session. We're looking at red arrows for London right now. The FTSE down 0.9%, 56 points to 62.24. Little change on the DAX and the CAC. Now, two senior Fed officials are blaming failures by the U.S. to contain the virus for sapping the recovery. Dallas Fed President Robert Kaplan called on U.S. officials to push for more widespread adoption of protective measures like the use of masks. Meanwhile, Boston Fed President Eric Rosengren told Bloomberg that America's eagerness to reopen before containing the virus has, he says, additional stimulus is needed because that has backfired. Let's listen in.
I think there'll be an appropriate time to have forward guidance. I think at this stage of the recession and the pandemic, that forward guidance probably is only mildly helpful. And the reason for that is the long-term treasury rate is still quite low, interest rates are quite low. And in that environment, I think people are already assuming it's going to be quite some time before interest rates rise again. So while it might be marginally helpful, I would actually say that our lending facilities and some of the facilities being run by the New York Fed are probably providing more support because they're getting at the cost of funds to individuals and businesses that I think are more important for what the outcome for the economy will be.
I want to talk about lending programs. Chairman Powell emphasizes, of course, that the Fed can lend, not spend. Is that the wrong prescription for the economy right now? Your lending programs have not seen a lot of take-up.
No, but they've been quite effective in many respects. So the announcement of our willingness to buy corporate securities quickly pushed those interest rates down. And as a result, we didn't need to buy very much because the market reacted to our announcement. So I would say credit conditions are much better than they were in March or April because of the Federal Reserve's actions. And I think that has been an important stimulus to the economy. In terms of spending, that has to come from fiscal policy. So the U.S. economy also benefited from the kind of very quick and very significant stimulus provided by both providing better unemployment benefits, broader unemployment benefits, checks to low-income individuals. All those things have been very helpful in preventing particularly low-income individuals from being able to continue to make spending decisions over the course of the spring and into the summer. But I think many of those programs have ended as of the end of July. The pandemic has not ended. The unemployment rate is still above 10%. So we need stimulative fiscal policy to continue. I think that's critically important that Congress come up with some kind of agreement to continue to provide support.
Have you modeled the impact from the end of that fiscal stimulus?
My personal assumption in my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
You supervise the Main Street program. That's perhaps the most controversial. According to your figures, $856 million in loans in the system, but it's a program that could do $600 billion in loans. Does that suggest modifications need to be made to the Main Street program?
Well, I'd highlight we've already made quite a few modifications. So we had an initial term sheet. We came out with a revised term sheet, and then it was revised once again to make the program broader and more accessible to a wider range of small businesses. We've also opened it up to the nonprofit sector. While we're not live on that part, banks are perfectly able to start the negotiations with the nonprofits. As you know, it takes a long time to actually negotiate a bank loan. So it doesn't surprise me that we would start gradual and that it would pick up over time. And so I think that's exactly what we're seeing. One reason we're seeing a lot of the lending coming primarily from community banks and mid-sized banks is they're probably a little bit more flexible and are able to adapt more quickly. I would expect that larger banks over time will start using the facility more. And the goal is to make sure that businesses that actually need it, that are creditworthy in February, that have had their cash flow disrupted, and are likely to be viable businesses after the pandemic is over, are able to get that kind of cash flow financing. And I think we are seeing a pickup in that activity. I expect as borrowers and as banks get more familiar with the program, we'll continue to see increases.
That was the Boston Fed President Eric Rosengren speaking to Bloomberg's Michael McKee, wrestling with some of the same issues as in other parts of the world. Deciding on the money is one thing, getting it to the places that matter is another. Let's take a look at some of your movers then. We are 25 minutes into the European trading day for Thursday, and here's a few of the stocks we're focused on. Airbus, the US, of course, stepping up pressure, as we discussed earlier, on Germany and France with extra tariffs on some goods, leaving the overall tariff picture unchanged, but certainly guiding more of those tariffs towards Germany and France. In amongst all of that, we do see a bit of movement on Airbus, down around 1%. ThyssenKrupp warning that losses will continue in the current quarter as the coronavirus crisis weighs heavily on its steel operations. We see that stock coming under considerable pressure. The stock is down by 9.6%. And Deutsche Telekom raising its forecast after closing the deal around Sprint in the United States. And we see Deutsche Telekom's shares up by 3% this morning. Up next on the program, money worries. Travel group TUI says it can power through the rest of the downturn despite revenues plunging 98% in the most recent quarter. We'll look at the sector's cash problems. To what extent can government money be used to offset the difficulties through the summer for these travel businesses? That is certainly part of the story at TUI. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open, half hour into the trading day now, and we're looking at, well, not a lot of movement on the continent, but you do see the FTSE down. Here you can see the Stoxx 600. It has moved down a little bit over the past few minutes, you can see, but it's only off about 0.4%. So the severity of the graph may be a little bit misleading in terms of the actual moves of the day. Probably better to take a look at the group rank return screen. GRR Go on any index with the Bloomberg terminal shows you the industry moves. Here you can see telecom's a big gainer after Deutsche Telekom put out pre-tax earnings, or operating profit, I should say, rather, that was more than €1 billion above the street estimate, so more than €9 billion, and we were looking only for 8. Here you can see retail stocks also doing okay, as well as real estate and consumer staples. Everything else is down, but basic resources, the biggest loser, and there you see all of the big ones, Rio, Anglo, BHP, are down. Metals also weak, and that may be why the FTSE, because most of those, of course, listed in London, is showing bigger losses than the rest of the European indexes. Now let's get the Bloomberg First Word News, today's top stories from the Bloomberg terminal. For that, we go back to London and Laura Wright. Laura?
Thanks, Matt. Presidential hopeful Joe Biden and running mate Kamala Harris made their first joint appearance last night. The event in Biden's hometown of Wilmington, Delaware, was dramatically scaled down from previous elections due to the pandemic. Ongoing restrictions may mean it's one of the only joint appearances of the Democratic ticket. Last week's blast in Beirut is hurting attempts to tackle the coronavirus. The explosion put 3 major hospitals out of action and also impacted more than 24 clinics. The World Health Organization says foreign medical teams in the country are diverting some of their focus to containing the virus. Australia added almost 4 times as many jobs as forecast in July, with unemployment surging by over 114,000. It shows recovery in much of the country is outweighing some of the impact of the new lockdown in Victoria, but the period does not cover the harshest restrictions in Melbourne, including the curfew. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, Matt.
Laura, thanks very much. Laura right there in London with your First Word News. Now, earlier this morning, tour operator TUI released earnings reporting revenue that plunged 98.5% from a year earlier. So business basically stopped. It says it can power through the rest of the downturn, though, but it has to get a big bailout. Whether TUI and the rest of the travel industry can survive boils down to that. How can they get extra cash? Bloomberg spoke to some of the biggest names in the sector.
So we get a vaccine or some sort of effective treatment, travel's going to have some issues.
It's going to be a bumpy road for this industry until there is a vaccine widely available and customers feel safe and confident to kind of resume normal activity.
I think the vaccine is great and is very important, but we cannot wait for the vaccine. I think we need to have a coordination among countries so that we can have a framework where we can have testing, contact tracing, and that would allow travel to resume.
Let's face it, a half-filled hotel is not profitable. So what we really need is that sense of safety. People want to feel that it's okay to travel.
Do I believe the peak, the worst is behind us? Absolutely.
This industry will recover in time because of the inherent desire and need for people to travel.
It will be a long while more before mass travel can resume. And that ultimately stems from consumer confidence. It stems from the availability of a vaccine.
We're going to be on a bit of a roller coaster for quite a while.
Joining us to discuss now is Danny Berger. So, Danny, in terms of TUI and the other travel companies, how is the liquidity picture going to look? Can they get enough cash?
Matt, they can maybe in the short term with some government support, but otherwise they find themselves in a really precarious situation because it's not just enough, as some of those executives were saying, that we get a vaccine or borders start to open and there's more confidence. The real issue here is one of timing, because these lockdowns happen at the peak of when these companies need cash. Now, this is from TUI's June presentation, and it shows how cyclical it is for them in their cash on their balance sheet. So when you get to the peak of the summer, which is the top of their cash position there, they need that in order harder for when you start moving into autumn to start paying off vendors for hotels and things like that. But this time around, they're not going to be able to reach that peak, which means as they need to start paying off people, they're just not going to have the cash in the coffers, not to mention that there are people who were unable to go on a holiday and are now asking for a cash refund. So you can see their estimates there in the pink dotted line of where they think will go. It starts to turn up once travel bans are lifted. But even if it turns up, they've missed out on their big period of being able to secure cash for the rest of the year. So sure, maybe things open up. Maybe later this year we get a vaccine. But then they are in those winter months where they don't get as many bookings or as much cash.
Danny, thanks very much. Danny Berger there with a look at some aspects of the travel.
Hey everybody, good morning. I'm placing new order to sell short Japanese yen at 106.703. Okay, the order placed at 106.703.
Looking at in terms of a bounce back?
Yeah, I mean, in terms of getting fully back to the 2019 figures that we were at before COVID broke, I think best case is probably 3 to 4 years to get to a full recovery.
So that seems like a long time, but it's actually not that far off what we're hearing from some other industries. But is there a possibility, Monique, that this is going to be the kind of thing that changes the industry forever? For example, I don't really want to fly on a plane sitting directly next to somebody. I'm now willing, where I previously would have tried to find the cheapest ticket, I'm now willing to pay a little bit more so that I can have a seat in between us.
Yes, absolutely. So I think there are some short-term implications, particularly until there's some form of vaccine or medical solution to the virus. So things like that being spread out on planes, people in hotels, for instance, not necessarily wanting to use group or communal facilities and amenities. And really what the companies need to do in order to get people comfortable is adapt their health and safety protocols and try and find ways of getting people comfortable with traveling again. Obviously, that's from the leisure side. When we think about the corporate side, there are obviously further potential long-term implications.
Yes, and let me ask you about those, because I know that you've been surveying some people who are responsible for booking business travel. Clearly, there's the cycle of this, or there's working through the virus and getting to the other side and rebounding. But then there's the structural change that results from changed business practices that we've all gone through over recent months. So, Monique, what size of business travel market do you expect us to bounce back to? What proportion of its former self?
Yeah, it's a really interesting question, and at the moment everyone's got a broad range of views on this. We had the Accor CEO saying last week that he thought there would be a 10 to 15% long-term structural reduction in corporate travel given the rise of virtual meetings and events. Citi, we surveyed 271 corporate travel managers across the UK, France, Germany and the US. And what we found was pretty surprising. I mean, 90% plus of them agreed that there would be some long-term reduction in corporate travel, given the rise of virtual meetings and events. And when we asked them about the reductions they expected into 2021 versus 2019, it was anywhere in the region of between 20 and 25% reductions in corporate travel spend that they were budgeting.
What, Monique, what trades do you want to get in on right now? I mean, things that have fallen far too much in terms of, you know, the sell-off, or things that we're going to be using more from now on, you know, food delivery services, et cetera. What do you think is a good buy right now?
Well, I think, as you say, in some ways it's safer to stick with those that have some form of benefit from COVID-19 and the lockdowns that have been imposed. So I look at online food delivery.
We have to remove the order to sell short. As you can see, it moved too fast. Yeah. Okay, let's see what's going to happen next.
Maintained post end of lockdowns. So they think that a lot of the customers they acquired during this period, they will keep long term, which actually fits with their business model. If you look at their customer cohorts over time, they're remarkably stable. Once you've got a customer on the platform for about 100 days, they typically stay with you. So in that space, I mean, we've been pushing Delivery Hero as a top buy there. The stock's performed well, but we still think there's a lot of opportunity.
All right, Monique, thanks very much for joining us. Really appreciate it. Monique Pollard is Citi Vice President for Travel and Leisure. Definitely a sector we're paying close attention to right now, especially with the TUI results. The company right now saying that it won't be doing any fire sales. It's going to try and hold steady through this with a little help from the German government. Speaking of Germany and Lithuania, lead calls for sanctions on Belarus after a widely disputed presidential election and violence in the streets that followed. My interview with Lithuania's foreign minister next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are almost 45 minutes into the session, 44 minutes now, and we're looking at a big drop in terms of the FTSE as the metals and mining stocks fall, the heavy metals and mining stocks. But the DAX and the CAC, although you see red arrows there, they are basically little changed. Now, calls for renewed sanctions on Belarus are growing. The nation's opposition leader has taken refuge in Lithuania after a disputed presidential election and a violent crackdown on protesters in Minsk and around Belarus. I caught up with Lithuania's foreign minister, whose nation is leading calls for new sanctions.
She takes time, so to say, and definitely she experienced some stress and pressure needless to say. So I believe she will be able to speak up when she will be willing and able later, because many requests, many want to hear from her, so I will not speak for her. Just to say that she's very important that she's free, she's united with her children, and that's the most important news for now.
Can you tell us what kind of, she said she was given a choice that she hopes no one else is ever faced with in Belarus, and you've said that some pressure was put on her. Can you tell us what kind of choice was given to her?
The choices were not too many, and one choice was to flee the country, and other choice was not good for her, I understood. So she decided to go out, and she has a Lithuanian national visa, valid for 1 year, and without any restrictions. Also, her children were in Lithuania already. That was yet another argument to choose this option, and that's how it was done. So the authorities didn't prevent, they even helped. Maybe it was part of their plan that she will be out of the country, maybe less organized opposition. I don't know. I will not make any, so to say, assumptions here, but here we are. So now it's the situation. So I believe I would suggest to focus on the events in Belarus now, what is happening, because it's unfortunately nothing good is happening, and this tensions and this brutality is ongoing and not calming down at all.
In the past, Lukashenko has repressed his citizens, votes have been questioned, sanctions have been applied, but then lifted later. It doesn't seem to have any effect. In fact, this is the first time we've seen him really openly, publicly brutalize his own citizens. Do you expect sanctions to be reapplied?
We're carefully projecting this cooperation, dialogue, selective approach, and when we see some progress, this is also fixed. And when sanctions were lifted, it's after they released political prisoners, let me remind. So it was some glimpse of hope that things will go for better. And now we see vice versa. Situation is different, and definitely all options are on the table, including sanctions. My personal conviction is that it's not enough to issue another statement about deep concern, what we are very creative to do, but it's not flying, making no impression whatsoever to anybody, including those authorities. So we definitely should discuss what kind of political consequences could be.
And that was the Lithuanian Foreign Minister Linas Linkevičius speaking with us yesterday. Anna, he told us as well that he is interested in the flow of troops, U.S. troops, that are going to come out of the German stations and rotate through Poland and Lithuania. And he emphasized that Lithuania is a country that does pay 2% of its GDP to the NATO, make those 2% NATO contributions.
So a number of dimensions to the conversation. Let's talk about the EU's response then, Matt, to what we've seen in Belarus. The EU has announced a meeting to discuss Belarus. That's going to take place tomorrow. In a statement this week, the EU claimed the presidential election was neither free nor fair. For more details, joining us now is Bloomberg's Alexander Kudrytsky. Alexander, good to speak to you. Have we seen any more protests in Belarus overnight?
Yes, we've seen the protests seem to be slowing down a little bit, but you should understand that there are now more than 6,000 people in prisons. So many people are already being distracted, so to say, by helping the people in prisons, trying to find relatives, trying to help relatives who are waiting near prison walls for their wives, sons, daughters to be released. The protests are still going on, but they have taken on a more peaceful tone. Yesterday, we've seen several hundred women protesting in Minsk and in other cities. Also, doctors came to the streets to protest. And today morning, as far as I understand, because it's very easy to have a clear view, there are many actions taking place across the country and in the city. in multiple places. As I understand, there are people lining. Yes.
Sorry.
There are people.
This level of violence publicly is new, but we've seen, of course, questionable elections in Belarus before. There were sanctions put on the leaders in 2010, 2011 that were then lifted in 2016. It's kind of like this happened already. What do countries like Germany and Lithuania, who've called for renewed sanctions, really expect that to achieve?
Well, I really cannot speak about sanctions or any actions which foreign countries may do for Belarus. I just only hope that any action which is taken helps to make this stop. Whether this is a dialogue or sanctions, this is really another matter. But this is true that the level of violence, we've seen violent crackdowns before, but this level is just outlandish.
And what is the expectation about how Lukashenko proceeds from here then, Alexander?
Again, I cannot. I can say I don't know. We have very few information coming from the government, just some statement in the official press. Well, right now things look. Right now it looks like stalemate, because people who are protesting, they obviously do not have the power to resist this violence, and at the same time, there are so many people protesting that. Yes.
We'll watch this story as it develops then. Thank you very much, Bloomberg's Alexander Kudrytsky. Thank you very much for joining us. Coming up on the European market open, this week's equity rally showed signs of fatigue, with stocks losing steam in the European session. We discuss with Market Live's macro strategist Laura Cooper next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are almost an hour into the session here, and we're seeing really still little movement, but down arrows in Frankfurt and Paris. The FTSE down almost 1%. Let's get in the markets now with Laura Cooper, our Bloomberg MLive macro strategist. And Laura, let me just start with the MLive question of the day. In terms of 10-year yields, you're asking, are they headed to 0.5% or 1% first? What kind of feedback are you getting?
Well, I think really the Treasury sell-off that we've seen in recent days, it doesn't necessarily mark a breakout. And, we're already seeing yields edge lower today. So, we have seen kind of this sell-off in bonds on account of kind of economic recovery hopes. We are seeing, markets price in kind of greater inflation. But on the opposite end of that, we have this relentless demand for safety. And I think it's going to really be a delicate balance between this flood of issuance and government's financing ballooning deficits going forward. So I think it's too soon to declare the end of the bond rally. I think the Fed is going to continue to support the market by buying further out the curve. And ultimately, there's still a great deal of uncertainty that remains around the outlook. So that's going to continue to bid these demand for havens.
Laura, thanks very much. Laura Cooper, Bloomberg Markets Live macro strategist with a look at the bond markets. European equity markets under pressure, in particular in London. Basic resources are down. This is Bloomberg.
Sky high, the S&P 500 shoots above its highest ever closing level before finishing off a few points shy of the mark. The rally hits pause today. The U.S. cranks up its tariff heat on Germany and France. Duties are designed to squeeze the EU into setting a long-running dispute over subsidies to Airbus. And Boston Fed President Eric Rosengren says over-eagerness to reopen the economy without containing COVID-19 has backfired in the United States. We hear from him this hour. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francie Lacqua here in London. Now, this is what the markets are looking at. We're also getting some breaking news out of the IEA, actually cutting its oil demand forecast as some of the air travel outlook darkens. Now, this is according to the IEA. If we go straight to the markets and have a look at those, and the story really is with the stocks. So yesterday, the stocks had quite a big move, and we're trying to figure out exactly what that means for earnings forecast for the future. What else I'm looking at is crude oil. You can see 42.56. That is after we had those IEA report. And then gold, a good litmus test on what exactly is going out there in terms of risk appetite, 1,930. European stocks really slipping as there are signs of faltering after stimulus talks in Washington remained in deadlock. Now let's get straight to the Bloomberg. First Word News here in London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Federal Reserve officials are warning failure to control the pandemic is undermining the economic recovery. Drawing a contrast with Europe, Boston Fed President Eric Rosengren says America's over-eagerness to reopen has backfired. He is concerned many temporary layoffs may become permanent job losses.
My personal assumption in my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
Now, last week's blast in Beirut is hurting attempts to tackle the coronavirus. The explosion put 3 major hospitals out of action and also impacted more than 24 clinics. The World Health Organization says foreign medical teams in the country are diverting some of their focus to now containing the virus. And the US is upping the heat over Airbus. It's adding extra tariffs on some goods from Germany and France. The move is designed to squeeze the European Union into settling the long-running dispute over subsidies to the aircraft maker. The US won a judgment from the World Trade Organization last October. The EU is waiting for a similar judgment against Boeing subsidies. That could come as early as September. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now let's kick it off with the markets. European equities and U.S. stock futures slipped as this week's rally in global equities shows signs of fatigue. Now the dollar weakened and treasury yields are ticking lower. Joining us now for more is Mark Cudmore from our MLive team. Mark, what are the trends that you're looking out for? Is it all about politics in the U.S. and the stimulus?
I think there are probably 4 things to watch. So one is obviously the stimulus divide in the U.S. The second theme is the U.S.-China trade tensions with the trade deal being reviewed this weekend. And I think that while that's kind of subsided from the radars in the last kind of 48 hours, that's still probably the biggest theme out there, those U.S.-China trade tensions going into the elections later on this year. And there's 2 other market themes I'm watching out. So while equities are kind of still nudging to highs and recovering the year-to-date gains in Asia, and, you know, the U.S. equity S&P is up testing its record high again, I think the other thing I'm watching is that commodities have been easing down in the last few days. And that's kind of weird. It's whether you look at gold or whether you look at even Bitcoin, whether you count that as a real commodity or not, or whether you look at copper. It doesn't matter whether it's the growth ones, the haven ones, the completely speculative ones. Commodities are easing off their highs in the last few days. And that, to me, implies that there might be some kind of deleveraging wave that we're kind of due. Now, the first half of August has been very good, but I think commodities may be a warning that either stimulus or U.S.-China trade tensions could be a negative catalyst for the second half of August.
Mark, what happens to treasuries in this kind of environment?
Well, at the moment, we've had this very weird dynamic in the last probably week that, you know, we've switched from the whole world talking about how low yields can go to suddenly getting worried about this yield rise. What's perhaps particularly ironic is that the nominal yield rise actually stopped when we saw CPI beat so strongly. I do think one of the things to take into account is that inflation expectations aren't as high as break-evens would imply. They're being deceived by the fact that break-evens are a market-derived thing, which is distorted by the liquidity premium in people seeking taking pips. There's a much greater liquidity premium than in normal treasuries, and there's also a fatter tail of outcomes in terms of that the market is very, very vulnerable to an extreme shift in inflation, so they need to buy inflation hedges, not because they believe it's actually going to happen. And that's why we saw this slight rise in nominal yield starting the end of last week into the start of this week, and that caused a little bit of nervousness in markets because there isn't that real belief in inflation out there. As for what it means for yields from here, I do still think we're trading that new narrative of that idea of, is there inflation trade possible? Is inflation really possible? I think we've got a little bit further to go in that. We haven't seen that much of a rise in yields yet, so I think we could see another few weeks in that. And I think that, again, will be a negative for stock markets, and that might tie into what's happening in commodity markets. Maybe commodity markets are the warning flag that this rise in yields isn't sustainable for markets more broadly. Is that going to be a theme that's going to last? No, because I think once yields cause a correction in risk assets, we'll see those yields come right back down very quickly.
Is this a binary moment, Mark, for what the market is looking at?
I think, look, I kind of highlighted this yesterday in terms of gold and copper both tested their 6-month trend line from the March low, from when we got the stimulus packages coming all around the world, and they hit them nearly perfectly. It was unbelievable. And then gold, had its second best day, I think, in 4 months or something, after rebounding off the trend line. Both of them bounced off their trend line. I think that if both gold and copper, so one is the haven panic metal, and one is the growth reflation, the world is wonderful metal, and so they both trade off different drivers. If they both crash through their 6-month trend lines this week or simultaneously, then I think that's a real warning sign. So I think that is the binary moment. Now, yesterday on the first test of that trend line, we survived it really well. So I think optimists, bulls, are the people who are in the strong hand at the moment, but we're not far enough away from those trend lines to be relaxed. I think that's going to be something we're going to be watching for the rest of this week. We either need to bounce back a bit higher, but if we close below those trend lines out of this week, I think there's a real problem for markets.
Great, Mark. Thank you so much for all of the insight. Mark Cudmore there joining us on the phone from Singapore. Now stay with surveillance. Plenty coming up, including Mario Greco, the chief executive of Zurich Insurance. He joins us. That's after the company reported a 40% drop in profit for the first half. He's still sticking with his 2020 outlook, so we'll speak to him next. And then a little bit later in the program, we also talk trade as the U.S. puts pressure on Germany and France, adding extra tariffs on goods following the Airbus dispute. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The biggest US and European banks added 19,000 staff in the first half of the year. That's as demand for loans and other services surged during the pandemic, and planned cuts were largely put on hold. 8 of the top 15 firms increased headcount over the 6 months. Only 4 did reduce it. Deutsche Telekom has raised its forecast and reported profit that did beat estimates. That's as T-Mobile's purchase of Sprint bolstered the parent company's finances. But the picture was more mixed in the telecom firm's home market. Mobile service revenue dropped over 1%, largely thanks to lower roaming fees due to the coronavirus pandemic. And Carlsberg is forecasting a slump in earnings this year. That's as the coronavirus-dense beer consumption in bars and restaurants. Operating profit will decline up to 15%. The brewer already scrapped its guidance earlier this year. Rivals AB InBev and Heineken both also reported a sharp drop in first-half earnings. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, Zurich Insurance is sticking with its estimate for full-year payouts of $750 million, despite taking a major hit in the first half. Group operating profit declined by 40% due to the pandemic. Europe's second-largest insurer by market value is now bracing for the full impact of COVID-19, as well as an active hurricane season. Well, joining us now is the company's chief executive. He's Mario Greco. Mr. Greco, thank you so much for joining us. When you look at actually the insurance business, I mean, 2020 has definitely been pretty rough for people, but especially the insurance business. What can you tell us, first of all, about the Beirut blast? What does that mean for insurance?
The H1 has been unprecedented. But what is most important is that beside the losses, beside the claims, it indicates the need for change in serving the customers. We're moving towards a digitally led world. And so we took this time to accelerate our digital investments. We upgraded our services. We have been able to serve our customers over the last 6 months from home, with the offices practically closed everywhere. And we're quite confident that we will keep improving this over time.
What needs to happen for the insurance industry to be able to provide protection to businesses from a pandemic risk like COVID-19 in the future?
I think, honestly, risks like pandemic, they go beyond any private sector. What we can do is to protect some customers in a limited sense, as we did. But pandemic, as we're seeing now, has such profound consequences that has to be covered by the governments, by the public, and by the private. And so we need to have a concerted agreement of private and public to take on the losses for the private customers and reimburse them, but it cannot be left to an insurance private solution. Insurance companies will not be able to do that.
But what are the lessons from COVID-19 that you can take away from it and maybe also use them for climate change?
The main lessons are in behavior of customers and in the change in the society. And these lessons drive us to think that the world will be much more based on technology and on digital interfaces than ever before. Of course, then we're also taking lessons on the clarity of our conditions. We had countries like Switzerland where conditions weren't very clear, and so we opted out for the best of the customers' outcome needs, but we will then clarify conditions going further. But the main lesson is about what is this opening for us, and what it does is it's a catalyst for a great shift in the way we live and in the way we demand services.
Mr. Greco, what has lockdown actually taught you about operating in these kind of circumstances? Are there any lessons to be taken on digital insurance, for example?
Sure there are. I mean, we were able to serve customers without problems. So during these months, we pay the claims, we issue policies, we acquire new customers, we even created new products. However, in terms of what we do for the customers, for example, in telemedicine, we are now considering investing in that sector as a consequence of this, because we understood during COVID that lots of customers needed to be cured but couldn't because the physical proximity was just impossible. I mean, they couldn't go to hospitals and they needed to be cured with digital solutions, with the remote solutions. So we're investing in that. If I consider travel and leisure, this is a sector which is completely upside down. We believe that leisure travels will start again progressively, but we think that business travels will be completely revolutionized by this situation. And so we have changed the services that we offer to travelers, and we have developed a very different approach, considering that leisure will become the predominant reason for traveling. So there are lots of lessons sector by sector. We were investing in shared mobility before. Frankly, when this started, we gave it a pause because maybe shared mobility is not going to be the most natural decision for customers over the next months. And now we want to see if that develops again or not. Lots of lessons learned.
And what about Zurich in general, or specifically? Do you still need all the office space that you have, or has it shown you that people can work from home quite well? And so is that a cost-cutting exercise that you would explore?
Yeah, look, I don't think the answer to these changes is going to be cost-cutting. Cost-cutting is always important, and being cost-disciplined and cost-conscious, as we have been over the last years, remains in the DNA of the organization and in our culture. However, you don't respond to what's happening just by cutting costs. In terms of office spaces, all the offices that we've been building over the past years already considered that people will work 1 or 2 days from home. So we were not providing 100% chairs and tables to all the employees belonging to that office. And that hasn't changed after this. Maybe that instead of 1 or 2 days, it would be 3 days. But we still believe that people will have interest, pleasure, and needs to come to offices once that the health and the safety conditions are completely restored.
Mr. Greco, just going back to Lebanon and Beirut, some of your competitors have said that they may see a major loss because of that. Do you have any exposure to the Beirut blast, or is it just too difficult to quantify at the moment?
Yeah, we're trying to understand ourselves. It's very early days for that. We don't think we have major exposure. Definitely, we will have some kind of exposure, but that does not look as something significant, relevant for us at all.
How do you expect 2021 to go? If we go back in these, lockdowns, potential lockdowns, how devastating could that actually be for your industry?
It's a great question. The real answer is I don't know. What to expect from the virus and from the reaction of the government over the next months, it goes beyond my capabilities. I personally don't think, and as a company, we do not think that the lockdown will be repeated as it was. That was part of understanding how to fight the virus. I think we know now how to do it individually and collectively as societies. I think we will find ways to contain it as we're doing right now, without going to the extremes. But I can't say more than that, because I really don't know, and I can't forecast that.
Yeah, no one can. So thank you for your honesty, Mr. Mario Greco. Thank you so much for joining us. He is, of course, the chief executive of Zurich Insurance, joining us this morning. Coming up, did America open too early? Well, the Boston Fed president says U.S. actions led to a resurgence of COVID-19, harming the recovery. Our interview with Eric Rosengren is next. This is Bloomberg.
So we get a vaccine or some sort of effective treatment, travel's going to have some issues.
It's going to be a bumpy road for this industry until there is a vaccine widely available and customers feel safe and confident to kind of resume normal activity.
I think the vaccine is great and is very important, but we cannot wait for the vaccine. I think we need to have a coordination among countries so that we can have a framework where we can have testing, contact tracing, and that would allow travel to resume.
Let's face it, a half-filled hotel is not profitable. So what we really need is that sense of safety. People want to feel that it's okay to travel.
Do I believe the peak, the worst is behind us? Absolutely.
This industry will recover in time because of the inherent desire and need for people to travel.
It will be a long while more before mass travel can resume. And that ultimately stems from consumer confidence. It stems from the availability of a vaccine.
We're going to be on a bit of a roller coaster for quite a while.
Well, those were some of the top names in the travel and tourism industry giving their view on the impact of the pandemic. Today, travel company TUI reported a $1.3 billion loss after the virus shut down travel, while revenue fell some 98% for the first 3 months, or for the 3 months to June, actually. So that's the second 3 months of the year. Shares are trading lower this morning. The market's focusing on the fact that in the U.S. we still don't have a stimulus. That's putting a bit of pressure on some of these stocks around the world. If you look at European stocks, they're down some 0.5%. I'm also looking at pound 130.71, and the IEA cutting its oil demand forecast as travel outlook darkens. Coming up, we'll look at the state of the U.S. economy. The jobs market is improving, but data on consumer activity shows retail spending is falling again in areas where the virus is spreading quickly. We'll have more on that next. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. In the US, stimulus talks remain in limbo with no sign of the stalemate ending. House Speaker Nancy Pelosi is rebuffing an overture from Treasury Secretary Steven Mnuchin to restart negotiations. She says that's because the White House won't budge on its demands, but Mnuchin pushed back, saying it was Pelosi who has actually refused to compromise. Now, presidential hopeful Joe Biden and running mate Kamala Harris made their first joint appearance last night. The event in Biden's hometown of Wilmington, Delaware, was dramatically scaled down from previous elections. That was due to the pandemic. Ongoing restrictions may mean it's one of the only joint appearances on the Democratic ticket. And Germany and Lithuania are leading calls for renewed sanctions on Belarus. That's as President Alexander Lukashenko cracks down on opponents after claiming a landslide election victory. Lithuania is among the nations offering to mediate between the two sides. If that doesn't work, the nation's foreign minister tells Bloomberg there should be consequences. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanna. Two senior Fed officials are blaming America's slow economic recovery on the country's failure to control the coronavirus pandemic. The Boston Fed President, Eric Rosengren, says an over-eagerness to reopen commercial activity without sufficiently containing the spread of COVID-19 has backfired. Well, he told Bloomberg that additional stimulus is now needed from Congress.
I think there'll be an appropriate time to have forward guidance. I think at this stage of the recession and the pandemic, that forward guidance probably is only mildly helpful. And the reason for that is the long-term Treasury rate is still quite low. Interest rates are quite low. And in that environment, I think people are already assuming it's going to be quite some time before interest rates rise again. So while it might be marginally helpful, I would actually say that our lending facilities and some of the facilities being run by the New York Fed are probably providing more support because they're getting at the cost of funds to individuals and businesses that I think are more important for what the outcome for the economy will be.
I want to talk about lending programs. Chairman Powell emphasizes, of course, that the Fed can lend, not spend. Is that the wrong prescription for the economy right now? Your lending programs have not seen a lot of take-up.
No, but they've been quite effective in many respects. So the announcement of our willingness to buy corporate securities quickly pushed those interest rates down. And as a result, we didn't need to buy very much because the market reacted to our announcement. So I would say credit conditions are much better than they were in March or April because of the Federal Reserve's actions. And I think that has been an important stimulus to the economy. In terms of spending, that has to come from fiscal policy. So the U.S. economy also benefited from the kind of very quick and very significant stimulus provided by both providing better unemployment benefits, broader unemployment benefits, checks to low-income individuals. All those things have been very helpful in preventing particularly low-income individuals from being able to continue to make spending decisions over the course of the spring and into the summer. But I think many of those programs have ended as of the end of July. The pandemic has not ended. The unemployment rate is still above 10%. So we need stimulative fiscal policy to continue. I think that's critically important that Congress come up with some kind of agreement to continue to provide support.
Have you modeled the impact from the end of that fiscal stimulus?
My personal assumption in my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
You supervise the Main Street program. That's perhaps the most controversial. According to your figures, $856 million in loans in the system, but it's a program that could do $600 billion in loans. Does that suggest modifications need to be made to the Main Street program?
Well, I'd highlight we've already made quite a few modifications. So we had an initial term sheet. We came out with a revised term sheet, and then it was revised once again to make the program broader and more accessible to a wider range of small businesses. We've also opened it up to the nonprofit sector. While we're not live on that part, banks are perfectly able to start the negotiations with the nonprofits. As you know, it takes a long time to actually negotiate a bank loan. So it doesn't surprise me that we would start gradual and that it would pick up over time. And so I think that's exactly what we're seeing. One reason we're seeing a lot of the lending coming primarily from community banks and mid-sized banks is they're probably a little bit more flexible and are able to adapt more quickly. I would expect that larger banks over time will start using the facility more. And the goal is to make sure that businesses that actually need it, that are creditworthy in February, that have had their cash flow disrupted, and are likely to be viable businesses after the pandemic is over, are able to get that kind of cash flow financing. And I think we are seeing a pickup in that activity. I expect as borrowers and as banks get more familiar with the program, we'll continue to see increases.
Well, that was Eric Rosengren, the Boston Fed president, speaking to Bloomberg's Michael McKee. Well, joining us now is Mark Anderson. He's co-head of global asset allocation at UBS. Mark, great to have you on Bloomberg Surveillance. Thank you so much for joining us today. When you look at the markets, when you look at what they're behaving, what they're worried about, does anything seem like it's in bubble territory? Do you worry about some of the valuations out there?
I think we've certainly seen that equity market valuation have gone beyond what they were pre-COVID, but we think there are good reasons for that to be the case. So first of all, it's obviously something that market participants have paid attention to, which is that central banks around the world are providing unprecedented stimulus, low degrees of interest rates. And that's really suggesting that multiples on equity markets can go beyond where they have been before. And if you plot charts where you look at where equity markets have rebounded back close to the pre-COVID levels, and with interest rates, if you look at the US 10-year even now with a slight move up around the 65 basis points mark, they're still very much in the doldrum, supporting the idea that central banks globally will stay low for longer, and that means that multiples can expand beyond where they were before.
Mark, what do you think the market is pricing in right now? Are they looking at politics in the U.S.? Or are they looking at a stimulus? And where could the biggest shock or shift come from?
I think there's certainly three main risks that we're looking at the moment. COVID-19, potential outbreaks is one of them. The second being U.S. politics around trade tensions. And then obviously we have maybe on the short term around the fiscal stimulus. And as with your interview with Rosengren suggested yesterday, I think we do have stimulus coming up in the U.S. We think that the Democrats and Republicans are likely to find their way maybe between the $1 and $2 trillion mark, but we might have to wait until September. But with everything else in place, some of the programs on the quantitative easing side, along with fiscal stimulus that have already been put in place, we think that we're still in for third quarter, which is likely to be one of the strongest in economic history.
What do you do with gold right now?
So gold is a good question. So we have a forecast of $2,000 per barrel. It might even extend a little bit beyond that. And we also have gold in the portfolios for our clients. We think that gold, obviously, as many have observed, has been driven by negative real rates in the U.S. currently of around 1%. That's been one key driver. We think that, and also looking at the core CPI figures yesterday, where the year-over-year number jumped to 1.6%, nominal yields more or less kept from the current levels, we think that real interest rates might actually take a slight move lower, and that means that gold prices are supported. And I think there's a second factor which is also being a bit debated now in the market, which is that do we have a bit of a tail risk around inflation? And we could maybe see that something like gold prices could do well if that kind of tail risk starts to increase in probability. But maybe when we look at commodities, it's interesting. A lot of the focus has obviously been around gold because of this parabolic move we saw in July with prices up around 11%. But we actually take a bit more of a holistic view on commodities and have recently added commodities to our client portfolios as well, expecting a more widened pickup in broad commodity prices that includes energy and base metals as well.
Mark, thanks so much. Mark Anderson from UBS stays with us, and we'll talk a lot more about the UK and Europe next. Also coming up, the US raises tariffs against Germany and France, stepping up pressure in the Boeing-Airbus fight. We'll discuss the latest developments in the trade relations next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Wirecard is losing its place in Germany's benchmark DAX index. It comes after a consultation which favored the immediate removal of bankrupt companies from the index rather than waiting for the quarterly review. Wirecard's successor will be announced on August the 19th. The changes will take effect from the 24th of August. Now, Cisco is giving a lackluster sales forecast, a sign businesses are spending less during the pandemic. In the quarter through October, revenue will fall up to 11%. The company plans to reduce expenses by $1 billion through a revamp that will include job cuts and early retirement. The plan will cost about $900 million. And Lyft has reported its worst financial performance as a public company, with sales plummeting 61%, but it's maintaining its forecast for a quarterly profit by the end of next year. It's a similar story to Uber that reported last week, but both companies face risks from the virus and a push for gig economy workers to receive employment benefits. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the U.S. is upping the ante over Airbus. It's adding extra tariffs on some goods from Germany and France. The move is designed to squeeze the European Union into settling the long-running dispute over subsidies to the aircraft maker. Meanwhile, European equities have also been on a wild ride this year, with markets seeing heightened volatility amid the coronavirus pandemic. So how have investors fared with the market turbulence? Well, still with us, Mark Anderson. He's co-head of global asset allocation at UBS. Mark, first of all, what exactly is the market pricing in terms of what a Biden administration, if you look at the polls, a real possibility actually looks like in terms of trade tensions with China?
That's a great question that we've obviously tried to speculate a lot around. And when we look at the polling markets, it looks like we might be getting a blue wave. That's at least where the betting markets are telling us that things might shift at this point in time. So when we look at the potential impact on markets, it's obviously very clear that up until the November election, we're going to see some volatility, particularly around the sectors. But for broad markets, we don't fear kind of a blue wave as much as you might think, because on one hand side, while we might be getting more in terms of taxes, so it's more or less clear we're going to see corporate taxes rise, we're going to get spending on the other hand side of that equation. So we think that the overall economy is still going to be sitting in a solid place to be supporting overall equity markets. So a blue wave is likely to be neutral, if not even slightly positive for global markets.
How do you make a difference between, for example, the European stocks or European assets compared to the UK and the US? Do you break it down regionally, Mark? And does the fortune of a lot of equities depend on where the headquarters?
That's a great question, and one of the things that we've been doing very recently, so as you might know, Francine, we're both long equities, commodities, credit, so we have really risk-on positioning in our broad portfolios. And what we've been looking at also regionally very recently has been where do we see some of the laggards that could be picking up. And when we look broadly in Europe, we actually think that UK equities are looking attractive, where we have an overweight position at the moment. So UK equities are trading roughly at a 30% discount relative to global equities. They're trading at a discount to European or EMU equities, which essentially means that there's a bit of a pickup potential also now when we see oil prices moving higher, currently $45 on Brent. We think that could go to 55 over the next 1 year, which is likely to support UK equities as well.
Mark, when you look at Asia, how much of a recovery will we see in Asia, and what do you do with some of the Chinese assets?
Good question. So we have daily monitors running, first of all, on observing where's Chinese economic activity these days. And very interesting, with the mail I got in the door this morning, was essentially telling us that when you look at traffic around the major cities in China, they're basically back exactly where they were pre-COVID, so from earlier this year. However, when it comes to investments, we had a longer-term positive view on Chinese equities, but again, a bit in the vein of what we're doing around UK equities, we think there's some laggards in the Asian region that might be benefiting a little bit more than China these days. So we've had positions recently both on Singapore and India where we could see a bit of a pickup to some of the great performance we've seen in China year to date.
What do you do with the emerging markets? So emerging markets, a lot of them are idiosyncratic issues, but then a lot of them are linked with what happens with dollar and the Fed.
No, that's a great question. And for the same reason, we think emerging market equities will continue to move higher. But where we've had more overweight positions for our clients, it's actually been around emerging market credit, so emerging market government bond issued in US dollars, currently yielding you almost 4% in addition to what you'd get on US treasuries. So what we do is getting a bit away from these idiosyncratic risks you mentioned, Francine, and really take a bit more of the broad perspective. We avoid some of the currency risk and really say that as long as these sovereigns are doing relatively well, they're being supported by rising commodity prices, broad economic rebound, we think that emerging market credit is the more favorable pick than emerging market equities.
Mark, a difficult question, but probably the most important. How much do you worry about rampant inflation if we put extra stimulus? Is it something that we should worry about next year and this year, just make sure that the recovery is in place?
Francine, I think that's really the core question that we are talking about internally as well. And one of the reasons we have tips in our portfolios, we have gold in our portfolios, we have commodities in our portfolio, is that we have a little bit of a tail risk, I think, on inflation. I mean, when we look at where excess supply is and also unemployment rates being relatively high, we don't think we're going to see a broad-based pickup in inflation. But you've seen inflation expectation creep high in break-even rates. We think with this extraordinary amounts of stimulus, there is a bit of a tail risk here, and that is something that we are very conscious about in our portfolios, and we're trying to protect also, obviously, the wealth of our clients from any potential flare-up in inflation expectations.
Mark, thank you so much for joining us. He is Mark Anderson, their co-head of global asset allocation at UBS. Now, coming up, Joe Biden and Kamala Harris make their socially distanced debut. Up next, we discuss the race for the White House. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
clearly the financial markets, we would say, are not necessarily reflecting what's going on in the real economy right now, which has been that demand destruction that we saw as a result of the current pandemic that we have. And so what it is actually doing is making it challenging to underwrite new investments in the marketplace as you're trying to predict, if you want to call it that, when we're going to come out of this pandemic and the impact that it's having on a global basis. We need to look at credits or investments that have an underlying durable, sustainable cash flow that we feel comfortable with. And equally so that when we look at those companies, and it's way more important today than I would say 10 or 11 years ago, is that we understand that margin of safety, or if you will, what that equity cushion is that we have in those investments. And that just makes it much more difficult.
That was Mark Jenkins, Carlyle Group Global Head of Credit, speaking exclusively to Bloomberg. Now, Joe Biden and Kamala Harris made their first joint appearance as running mates. The Democratic candidates for president and vice president promised to bring steady leadership to the White House and attack Donald Trump for his failed response to the coronavirus pandemic.
There's a reason it has hit America worse than any other advanced nation. It's because of Trump's failure to take it seriously from the start. His refusal to get testing up and running, his flip-flopping on social distancing and wearing masks, his delusional belief that he knows better than the experts. All of that is reason, and the reason that an American dies of COVID-19 every 80 seconds.
Well, joining us now with the latest is Bloomberg's Anne-Marie Hordern. Hi, Anne-Marie. So what was the main takeaway from the event?
Good morning, Francine. Well, I think you heard part of it there. The main takeaway really is that both Joe Biden and Kamala Harris took aim at President Donald Trump. And yes, it was due to the handling of the pandemic and the health crisis in the United States, but also the economic crisis that had ensued from that. Climate change as well, with Joe Biden saying that would be key for their administration in a place where they could see the creation of jobs. And then on top of that as well, of course, the issue of racial justice and the crisis really that America is grappling with. All of these, they took aim at Trump for. And that was really the overarching theme as they both took the stage yesterday. Francine, it's very interesting because this is one of the few possible joint appearances we're going to see. And you want to see the chemistry of this brand new ticket, but due to the pandemic, it was a very different kind of style. Usually have massive, enthusiastic, filled halls. But it is their first introduction, and throughout that, we saw Kamala Harris really weave her own story, her own biography within those attacks on Trump. She did talk about being a prosecutor and basically the case of Trump and Biden, how she would prosecute that. This is something the Democrats want to see from her, of course. We saw a lot of her interrogation skills during the judiciary hearings in the Senate, and that is something they want her to bring out in the open against Trump, Pence, and especially with Vice President Pence in October, Francine.
Anne-Marie, what have we learned about the ticket?
Well, one thing I think is very interesting is just the amount of money that poured into the campaign since Joe Biden announced that Kamala Harris was going to be his running mate. North of $20 million came in and 150,000 new first-time contributors. So there obviously is some excitement within the Democratic Party that this was his running pick. She is a black woman. She's also of Asian woman. So it is really historic, and it just goes to show, I think, Francine, that this is more of a reflection of the Democratic Party, which is becoming more female and less white. And this is, of course, something they both talked about yesterday, about the historicness, how historic and how significant it was, their ticket together.
Anne-Marie, thanks so much. Anne-Marie Hordern there with the very latest on this new ticket making history. Now, this is what the markets are looking at. So the markets really focusing on the fact that there's no stimulus, or at least no, opposing economic bets from both President Trump and Nancy Pelosi mean that they're now in a stimulus standoff, and that's kind of at the margins hurting some of the markets. European stocks down some 0.3%. Now, Bloomberg surveillance continues in the next hour. We'll be talking with Jason Furman, professor of economics at Harvard Kennedy School. This is Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. Sky high, the S&P 500 shoots above its highest ever closing level before finishing a few points shy of the mark. The rally hits pause today. No compromise. Democrats and Republicans point the finger at each other. The two sides remain trillions apart on a relief package. And Boston Fed President Eric Rosengren says over-eagerness to reopen the economy without containing COVID-19 has backfired for the U.S. We hear from him this hour. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Lisa Abramovitz stepping in for Tom Keene in New York. Lisa, good morning. We look at the markets, we look at the politics, and of course, we look at the new ticket in town, which is Biden-Harris and exactly the policies that they'll put in place.
And we look at jobs, the fact that there still is expected to be 1.1 million Americans who file for jobless claims this week. We're going to get that data at 8:30 a.m. Eastern, and really that is the backdrop to the stimulus talks as well as some of the political pressure ahead of November.
Yeah, we have a lot to talk about for a Thursday in August. Now let's get straight to the Bloomberg First Word News in New York City. Here's Karina Mitchell. Hi, Karina.
Good morning to you. Joe Biden and Kamala Harris gave a preview of what the fall campaign may sound like. They made their first joint appearance as Democratic running mates, tearing into President Trump for his failed response to the coronavirus pandemic. The event could end up being one of the few times the running mates actually campaigned together. Pandemic restrictions have limited Biden's in-person events. Meanwhile, President Trump can make his nominations acceptance speech from the White House lawn or executive residence. That's according to a government advisory opinion. Generally, U.S. government employees are barred from conducting political activities while in a government building. The U.S. is stepping up the long-running fight over illegal subsidies to Airbus. The Trump administration is imposing extra tariffs on some goods from Germany and France. At the same time, certain products from the UK and Greece are being taken off the tariff list. Last fall, the U.S. won a World Trade Organization judgment allowing it to impose extra tariffs because of the Airbus dispute. And in the UK, Prime Minister Boris Johnson's government faces a coronavirus dilemma. How it responds could set the tone of the economy for years to come. If it withdraws the massive support for jobs and wages too soon, it could tip the UK into an unemployment crisis. If it extends the aid, that could keep Britons from quitting jobs that may never return anyway. That would mean a necessary restructuring. Global news 24 hours a day on air. A Bloomberg Quick Take powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Thank you so much, Karina. Now, this is what I'm looking at in the markets. A lot going on in the markets and a bit of volatility, which I guess is not unusual for the month of August, but it does seem to be accelerated because of all the uncertainty out there. Now, first of all, the IEA actually cut its oil demand forecast, and now they think that the air travel outlook will darken. So I'm looking at crude oil in the U.S., not really budging on the back of the news, but still important to show it, $42.74. European stocks slipping, U.S. futures actually fluctuating. Again, this is after we saw a global rally yesterday, which definitely showed signs of faltering. We had stimulus talks in Washington remaining in deadlock, the dollar falling before this key unemployment data
in the U.S. and the U.S. 10-year yield at 0.65 for 1. Lisa.
Fran, just to build on what you were talking about with the bond yields, you had seen a couple of days of rising yields. We're seeing that trend reverse today after a series of better than expected auctions, record size auctions of U.S. Treasuries, 30-year yields now breaking a 4-day rising streak and declining ahead of a $26 billion auction later. And gold getting a bid, Fran, which I think is interesting given the fact that it had sold off the most since 2013. People saying, was this the end of gold's incredible run? Not so fast, climbing back toward that 2000 mark. Really interesting to see, Fran, whether we're going to get any kind of reaction in NASDAQ futures going into that 8:30 print of jobless. How do traders respond to the increasingly bleak economic news around the world at a time of unprecedented stimulus?
Lisa, joining us now to talk about all of this is John Normand. He's JP Morgan Head of Cross-Asset Fundamental Strategy. John, always great to speak to you, so thank you so much for coming on Bloomberg Surveillance.
My pleasure.
Good morning. When you look at the markets and when you look at exactly what they're pricing in, you know, what is the focus on? Is it on stimulus? Is it on the election? Is it on COVID? Is it on almost too many things for them to actually, you know, get it right?
I think the general focus of markets, given that we're near the all-time highs on stocks and we're at reasonably tight levels on credit spreads, is that the expansion is going to continue and there won't be any big policy mistakes. And that's probably a bit too optimistic, especially when you watch how the fiscal discussions are going on in the U.S. So I do think there are some risks of this rally stalling simply because of the inability of Congress to come to a quick conclusion on stimulus. But until we actually see the key macro indicators start to buckle, I think markets are going to stay quite elevated. It's very hard to fight the momentum in the macro data, and that momentum is pretty powerful right now.
So, John, what do treasuries do from here?
I think Treasuries are going to edge up because we are going to see a continued lift in inflation, reversing some of the decline that we saw in inflation in the spring. But for the most part, I think your rising yields is maybe limited to another 25 basis points from here on 10-year rates. You know, keep in mind that even as inflation starts to normalize from the depressed levels in the spring, it's still going to be in a very low range for the next couple of years at least because of high unemployment and what that does to wage pressures. So if you're going to have wage pressures bearing down on overall levels of inflation, if you're going to have extraordinary monetary stimulus, if you have zero policy rates for the next several years, it really does put a ceiling on rates. I'd say it's, you know, they're going to go no higher than maybe another 25 basis points from current levels through the end of this year.
It's interesting in the tension in how you respond to the two questions here. You've got on one hand stocks that are blind to stalling talks in Washington. On the other hand, you've got the Fed backstop. I want to stick with the first point for a second, this idea that stock investors are shrugging off the idea that you have a complete stalemate in D.C. that does not seem to be softening, and every week that goes by, the economy is losing steam. How big of a risk is this? Let's say we do get some sort of momentum stall. How big could the sell-off be in the face of no stimulus deal and no sign that there's going to be one within the next few days, perhaps even weeks?
So I think if it's just another few days of delay, this is probably not a big deal for markets, mainly because you have had some action out of the White House in the last few days that are providing some temporary, albeit reduced support to households through enhanced unemployment benefits. I think if this debate stretches into September and if the market is aware that President Trump's measures are really going to expire maybe at the end of September, beginning of October, this is a bigger issue. The size of the market correction, I would say maybe only 5% because it doesn't look like there's a lot of heavy positioning in the stock market on the part of hedge fund investors. It's probably more the longer term investors who have been increasing their equity allocation over the past several months. They're probably going to be less willing to sell in response to this Washington news flow than would be hedge funds. That's why I think the drawdown would be limited to maybe the mid-single digits. But, you know, make no mistake about it, this is an economy that really relies on these fiscal transfers. And if these transfers are going to be reduced through the end of the year, it's going to be, I think, extremely difficult to see any further gains on risky markets. And I think you got pretty decent odds of some drawdown.
And John, I think a lot of people agree with you that the economy remains incredibly vulnerable and really relies on an additional round of fiscal input. And yet the economy is not the stock market, and the stock market has been boosted by the Federal Reserve. And that goes to the yield point that you were talking about. How much does the Fed have to step up its game, increase its balance sheet, engage in a greater degree of monetary easing and stimulus on their front that isn't necessarily trickling into the real economy as quickly, if the U.S. government does not pass some additional round of fiscal support?
So if there's no fiscal support passed over the next 1 month or 2 months, I don't think the Fed is necessarily going to step up its actions. It may increase slightly the amount of asset purchases in the credit markets. If we see credit spreads widening to an unreasonable degree, maybe another 30 or 40 basis points wider on high grade spreads. But for the most part, there's very little substitute for households for these fiscal transfers. So all the Fed can do is minimize the asset market consequences of a policy mistake between Congress and the White House, but they can't actually create anything replicating that income transfer. And really, I think their actions in financial markets are going to be limited to stabilizing credit because that's what they can buy. They can't directly influence stock prices through those actions.
John, what's priced in the markets right now? A stimulus deal? I mean, it seems actually pretty incredible that that if the U.S. doesn't get anything.
I think a deal is priced in, partly because Washington eventually does the right thing on fiscal policy, even if it's not always a preemptive move, and even if it takes several iterations to get that deal through. So I think the fact that markets are so well behaved in the context of these risks tell you that investors are pretty much expecting something to happen, and maybe if it doesn't even happen until September or so, it could be backdated, so there will be some makeup strategy in terms of the income transfer. So it seems to me like the optimistic case is already in the price.
John, thank you so much for joining us. John Norman there of JP Morgan. He, of course, stays with us. We'll talk also about emerging markets and Europe. Coming up in the next hour, we talk about stimulus. We also talk about the Democrats with Jason Furman, Harvard Kennedy School professor. That interview is coming up at 6 a.m. in New York. That's 11 a.m. in London. And this is Bloomberg.
You see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Clearly, the financial markets, we would say, are not necessarily reflecting what's going on in the real economy right now, which has been that demand destruction that we saw as a result of the current pandemic that we have. And so what it is actually doing is making it challenging to underwrite new investments in the marketplace as you're trying to predict, if you want to call it that, when we're going to come out of this pandemic and the impact that it's having on a global basis. We need to look at credits or investments that have an underlying durable, sustainable cash flow that we feel comfortable with. And equally so that when we look at those companies, and it's way more important today than I would say 10 or 11 years ago, is that we understand that margin of safety, or if you will, what that equity cushion is that we have in those investments. And that just makes it much more difficult.
That was Mark Jenkins, Carlyle Group Global Head of Credit, speaking exclusively to Bloomberg Television. Speaking to that conundrum among investors, how do you buy junk bonds at near record low yields at a time of growing risk? Joining us now to talk credit and beyond is John Normand of JP Morgan. John, I want to start there, given the fact that issuance of junk bonds has gone past where we were all of last year. You're seeing junk bond yields fall near record lows. How do you reconcile this incredible rush for riskier assets at a time of rising bankruptcy and increasing corporate distress?
I think it's a difference between the time horizon that different types of investors are focused on. I think if your horizon is the next 3 months, the next 6 months, yes, you're going to see rising delinquencies and bankruptcies and the sorts of things that would normally challenge credit markets if they were persistent. But if your time horizon is the next 1 year or 2 years, you're probably looking at a recovery that begins to look a bit more complete. Corporate profits get closer to the pre-crisis peaks. Defaults begin to also start to move lower, and then the valuations of the credit markets don't look so extreme. So I think there's a whole clutch of investors in the world who are focusing a little more on the 1 to kind of 2 year horizon and thinking about how profits are going to be restored, how the liquidity environment is going to be sustained, how the expansion could go on for a number of years. And these are all the things that make them want to hold these assets now, even if there could be some interim drawdown in prices over the next 3 or 6 months.
John, this sounds good and it makes sense. If you want extra yield, you go into something that offers higher yields. And then on the flip side, people are saying, why are all these investors closing their eyes to the growing risk of bankruptcy, of insolvency, of actual principal write-down of a lot of these bonds? What do you say to that? I mean, is this policy of suppressing yields and pushing investors deep into risk at a time of incredible distress economically, potentially fraught and setting the economy up for a fall, if not the investors that go into this debt?
Well, I think there is differentiation when you look underneath the index level. So if you look at the relative performance of different sectors, whether that's in credit or equities, you do see quite a bifurcation in the market where these in-game winners like tech are doing meaningfully better than some of these older economy stocks or some of the COVID victim sort of sectors. So there is some, I think, credit homework, name-specific homework, sector-specific homework going on. You're right, the overall level of the equity market continues to rise. All sectors are rising, but there are big performance gaps between them. So people aren't completely indifferent to some of these issues that you're mentioning. I guess they're just still willing to be more or less fully invested because they think that at some point over the next couple of years, there'll be this confluence of policy stimulus, return to normal growth, vaccine that normalizes the profit cycle too, and they want to be pre-positioned for that. But you're right, there's no risk premium in the markets for something going wrong in the interim.
John, you nicely put in your note looking at cross assets that if you look at the currencies, the global macro environment definitely continues to send mixed signals for FX. What do you do with dollar right now?
I think you have to be very selective or pair-specific in terms of your view and your investments, recognizing that some big things have changed structurally in the currency world. The most important thing that's changed structurally in the currency world is that EM rate spreads to dollars are historically low, even though some of the imbalances in some of the big EMs like Brazil, South Africa, Turkey are still quite large. They're record large in some cases. And so EM is not the carry opportunity it used to be. And if it's not going to be the carry opportunity it used to be, you shouldn't be selling dollars broadly against the EM complex. You should sell dollars versus a couple of high yielders like Mexico and Brazil. You should sell them versus North Asia, which is benefiting from a much more robust growth cycle than the rest of the EM complex. Within the G10 complex, you can sell dollars versus currencies of countries that have a strong balance of payments profile like Japan and Europe. And the rest of the basket, you can either be neutral dollars or long dollars. So it doesn't add up to a big trade-weighted decline in the dollar, even though I do think the dollar is going down in trade-weighted terms. But the message here is really about selectivity. It's not the same kind of world structurally that it was pre-COVID.
What does a Biden administration actually mean for dollar? I don't know whether, we fully modeled out what it actually means for trade tension between the U.S. and China.
So I feel like the clearest currency path from a Biden victory is a lower dollar versus North Asia. So China, Korea, Taiwan, basically on the view that we won't see aggressive sort of impulsive measures taken against China on the trade front, even though obviously the conflict on a multi-dimensional basis is going to persist between the U.S. and China. But at least you wouldn't have to worry about waking up one day and seeing the tariffs have gone up on those Asian economies. And that to me is what will increase equity market outperformance. This will sustain flows into those markets that pushes the dollar lower versus Asia. For the rest of the currencies, I don't think there's a big impact from Biden. You might say that if there's a Democratic sweep, so the Democrats control all branches of government, that there will be an infrastructure spending program, looser fiscal policy. This is good for growth. But because I don't think that increase in growth from infrastructure spending is going to translate into meaningfully higher interest rates in the U.S., I don't think the dollar is going to capitalize broadly on that. So if you believe Biden's going to win, you buy Asian currencies. If you want to look beyond that, I'd say don't really trade this through currencies. Trade this through some of the specific sectors of the U.S. equity market, like infrastructure or materials or metals and mining stocks.
John, thanks so much. John Norman there of JP Morgan stays with us. Now, coming up in the next hour, Dana Telsey Advisory Group Chief Executive Officer. That's coming up at 6:30 a.m. in New York, 11:30 a.m. in London. We'll talk about consumers, of course, behavior. We'll talk retail and unemployment. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
We still got 1.8 million, with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. Airbnb reported plunging revenue and mounting losses in the second quarter, but Bloomberg has learned that the home-sharing startup is still considering an IPO before the end of the year. Sales were down 67%, an indication of the impact of the coronavirus on global travel. Meanwhile, Bloomberg has learned that Palantir Technologies is planning to go public through a direct listing of its shares next month. The company sells data analysis software used by governments and large companies. A direct listing would allow Palantir's current investors to sell shares on the first day of trading rather than waiting for a lockup period to expire. And shares of Cisco are lower today. The internet networking product maker gave a lackluster sales forecast for the current quarter. It's a sign that businesses are spending less in the recession. Cisco's hardware-related sales fell 16%. And that is the Bloomberg Business Flash.
Thank you so much, Karina. Just taking a look today at markets, we're seeing a pretty quiet day. NASDAQ futures fluctuating ahead of the U.S. Open. We're seeing the dollar weakening close to the weakest in September 2018. 30-year yields breaking a 4-day rising streak. I find this interesting. It comes ahead of an auction of $26 billion of the debt, another one of the record auctions that are going to total $112 billion of U.S. Treasuries sold this week, a record as they try to finance the deficit in the United States. Gold getting a bid, Fran. Interesting to see that gold is getting a bid after that sell-off.
Yeah, gold seems all over the place this week, Lisa, so I'm not sure what to make of it anymore, but it's certainly in tandem sometimes with treasuries and sometimes not. Overall, European stocks are actually dropping. Futures seem to be slipping a touch. A lot will depend on what we see in terms of that unemployment data. And then I have to say here in Europe, maybe more than the U.S., people are starting to worry that these stimulus talks in Washington are at deadlock. Gold resuming its advance, as you mentioned, the Treasury 10-year notes actually heading for their first gain in a week after yields closed at the highest since early July. I know we'll talk a lot more about stimulus. We'll talk a lot about the barriers that there has been between the Democrats and the Republicans. We'll talk about the new ticket in town, the Biden-Harris ticket, and we'll also talk about some of the other things that we're seeing with oil, Lisa, as well.
Yeah, and I'm particularly curious to see the jobs number and, frankly, what the reaction is going to be in markets. Does it mean if you have a really terrible jobs report that there's more pressure on Washington, D.C. to come together? It was good news, bad news, bad news, bad news. Really hard to tell, Francine, the sort of connection right now between real data and the actual market.
Yeah, and then we, continue looking at the virus update, and of course we try and track COVID-19. I know here in Germany, and actually infections are rising, and there seems to be new cases of people that were infected that have now been reactivated. So we'll have plenty more, of course, on COVID-19 and the impact on the economy. Also coming up on Bloomberg Markets, Robin Hayes, JetBlue chief executive, will talk about COVID-19 and some of the travel precautions being put in place. That interview 10 a.m. in New York. That's 3 p.m. in London. And this is Bloomberg.
it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Lisa and Francine from London and New York. Now let's get back to John Normand of JP Morgan, who's still with us. John, we talked about treasuries, we talked about U.S. assets, we talked about gold. Let me talk to you about UK assets, because I haven't talked to you about Brexit or, of course, the UK for at least 2 weeks. We heard from the Bank of England, and they tried to map out the fact that they're looking at negative rates, they don't want them, they're not here yet. But is there an ideal time to use negative rates, and how much of a surprise would that be for the markets?
I suppose the ideal time is if it seems like the best way to stimulate the economy is through a weaker currency, because I think of negative rates as maybe having this unambiguously negative consequence for the exchange rate, because it widens out the carry differential. So if policymakers ever came around to the idea that currency was really the path they wanted to move down, then negative rates could be quite helpful in achieving that objective. But I think most central banks are of the mindset that influencing the price of domestic assets, it really gives you the most leverage, and that's through increasing activity in the credit markets more than the bond markets, because rates are already so low, or increasing activity in the bank loan markets. And that's, I think, the preferred channel for pretty much all central banks now. Even though they would all like probably a weaker currency, they realize that a bilateral exchange rate is also determined by all these foreign factors which are outside their control. So best not to kind of go down a route like negative rates, hoping that the currency would go down, but finding that move impeded by what's going on internationally. So I'm still of the view that negative rates aren't going to happen in the UK.
John, do you think the UK is much more concerned than other parts of the world, given COVID, given the possibility of a second wave, but also given Brexit? Unclear whether the UK government will actually ask for an extension.
I think the UK is the riskiest of the major economies to invest in, precisely because of that very specific risk of the hard Brexit. It could be a de facto hard Brexit, meaning no deal. It could be an implicit hard Brexit through a very narrow deal that only covers goods. But it seems like this is an economy which is faced with pretty high likelihood of another shock to the corporate sector, while it's already trying to deal with all of the adjustments from.
Okay, ladies and gentlemen, new order placed for euro at 118.28.9. New order placed at 118.28.9. Position opened. That's a long position for euro at 118.28.9.
It's dominated by a lot of big multinational corporates, particularly in the resource space, and so it's a bit divorced from what's going on with domestic activity. Once you look at smaller and medium-sized corporates, these are the ones that are more vulnerable. So it wouldn't surprise me if a broader index, a FTSE 250, lost 5 or 10% of its value on a hard Brexit, and I don't think you really have the backstop to support the equity market the way a number of other countries have backstops for policy mistakes.
The UK certainly has been left out of what many people view as the recovery in the continent of Europe, and people are saying that is the place to invest. The narrative saying they've been recovering faster than places like the United States from the virus and have a better plan to get beyond this. Do you agree with sort of the groundswell toward European assets, or do you think it's overdone?
I think it's overdone at the broad level, meaning if you're comparing broad indices, MSCI, EMU, to the S&P, I don't think it's sufficient to say that Europe is better at managing the virus, therefore you should be overweight that index, because that index obviously has a much lower weighting to market-leading sectors like tech and communication services versus the U.S. And this is why the U.S. and Europe on a dollar basis, meaning common currency have been delivering the equivalent returns over the past 4 months, even though Europe has been much better at flattening the infection curve than the U.S. So it's not just about economic momentum, it's also about sector composition. If you look, though, at sectors, maybe you could make the argument that consumer stocks should do better in Europe than in the U.S. because there are fewer risks to consumer confidence in a place like Europe, which is better at managing the virus. So if you're comparing, purely domestic sectors on a like-for-like basis, maybe Europe does deserve the nod. If you're looking at an index basis or a country basis, I still think you stick with the U.S., and that's basically because I think tech remains the leader.
I was going to ask about tech, John. What do you do with tech? I mean, we were looking at some of the valuations a couple of weeks ago, thinking, is this really deserved? Talking possibly even about a bubble, and then they came out. The big stocks came out with some pretty impressive earnings.
I think that's the key here. When you think about the levels, you really have to judge them relative to the earnings momentum. And the fact is that tech is one of only a couple of sectors in the index which is delivering year-on-year earnings growth. It is for structural reasons, partly related to COVID and structural reasons that even predated COVID. So unless you can really argue that those structural forces are going to reverse, I think it's premature to be underweighting those sectors. Maybe you could make the argument in 2021 that assuming mass vaccination, there's going to be less of demand for the kind of things that tech companies deliver. But I think of that as a temporary pause in tech outperformance. Tech was leading before COVID, and some medical solution to COVID in the next year is not going to change the long-term thesis for tech, even if it is going to change the shorter-term risk-reward around that sector.
If there's a Biden administration, John, after the election in November, what does that mean for taxes for certain sectors, and how does that change, where you want to put your money?
So I think it's going to mean higher corporate taxes on the assumption that there's a Democratic sweep, because obviously the Senate has...
Stop on profit for euro at 118.30.9. 118.30.9. Stop on profit.
So I think on a kind of a 6-month basis, there's not much that's really tradable at the index level around a Biden victory and a Democratic sweep. The shorter term issues are a little more complex depending on whether investors want to focus on just the tax issue now or focus on how that tax money is going to be redeployed into the economy. But highest conviction view is that if we get the Democratic sweep, number one, you want to be overweight infrastructure, material mining, material stocks and metals and mining stocks, because we will get some sort of bid through greater domestic infrastructure spending. And number two, you want to be overweight Asian equities and also Asian currencies, thinking that we'll have a much more sort of thoughtful and less aggressive and less impulsive foreign policy out of the Biden administration.
Thank you so much, John Norman there, JP Morgan, head of cross-asset fundamental strategy. Now let's get straight to the Bloomberg First Word News in New York City. Here's Karina Mitchell. Hi, Karina.
Francine, Democrats are showing some enthusiasm for Joe Biden's running mate. The presidential nominee says the campaign raised $26 million in the first 24 hours after he picked Senator Kamala Harris to run with him. Biden and Harris made their first joint appearance in Biden's hometown, Wilmington, Delaware. House Speaker Nancy Pelosi says she's turned back an overture from Treasury Secretary Steven Mnuchin to restart stimulus talks. Pelosi says the White House hasn't budged from its demand that the stimulus be smaller. She's offered to come down $1 trillion if Republicans raise their offer by $1 trillion, but Mnuchin accuses Pelosi of being the one who won't compromise. Meanwhile, President Trump ramped up his effort to get schools to reopen. He met at the White House with parents, educators, and researchers who argued for in-person learning. The president says it's ridiculous that some districts plan to have students attend in person some days and online on other days. And Defense Secretary Mark Esper appears to be on his way out. Bloomberg has learned that President Trump has said privately he intends to replace Esper after the election. The president is said to be frustrated by Esper on a number of issues, among them that he pushed back on the idea of deploying troops to those recent protests. One person says Esper plans to leave regardless of whether the president is reelected. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thank you so much. Now, coming up in the next hour, Wendy Schiller, Brown University Department of Political Science professor and chair, will have a good conversations about the U.S., but also international trade relations. That's at 6 a.m. in New York, 11 a.m. in London, and this is Bloomberg.
I'm moving up my stop and profit for euro at 118.33.9. Okay, stop and profit move to 118.33.9.
Nothing happened to our house, nothing broke. I just didn't realize that it would happen here in North Carolina, honestly.
It's such an interesting new world.
The world is changing. For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
I'm Lisa Abramowitz in New York with Francine Lacroix in London. America's rush to reopen the economy before containing the coronavirus is backfiring. That's the view from Boston Fed President Eric Rosengren. He told Bloomberg's Michael McKee that extra stimulus is required.
I think there'll be an appropriate time to have forward guidance. I think at this stage of the recession and the pandemic, that forward guidance probably is only mildly helpful. And the reason for that is the long-term Treasury rate is still quite low, interest rates are quite low. And in that environment, I think people are already assuming it's going to be quite some time before interest rates rise again. So while it might be marginally helpful, I would actually say that our lending facilities and some of the facilities being run by the New York Fed are probably providing more support because they're getting at the cost of funds to individuals and businesses that I think are more important for what the outcome for the economy will be.
I want to talk about lending programs. Chairman Powell emphasizes, of course, that the Fed can lend, not spend. Is that the wrong prescription for the economy right now? Your lending programs have not seen a lot of take-up.
No, but they've been quite effective in many respects. So the announcement of our willingness to buy corporate securities quickly pushed those interest rates down. And as a result, we didn't need to buy very much because the market reacted to our announcement. So I would say credit conditions are much better than they were in March or April because of the Federal Reserve's actions. And I think that has been an important stimulus to the economy. In terms of spending, that has to come from fiscal policy. So the U.S. economy also benefited from the kind of very quick and very significant stimulus provided by both providing better unemployment benefits, broader unemployment benefits, checks to low-income individuals. All those things have been very helpful in preventing particularly low-income individuals from being able to continue to make spending decisions over the course of the spring and into the summer. But I think many of those programs have ended as of the end of July. The pandemic has not ended. The unemployment rate is still above 10%. So we need stimulative fiscal policy to continue. I think that's critically important that Congress come up with some kind of agreement to continue to provide support.
Have you modeled the impact from the end of that fiscal stimulus?
My personal assumption in my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
You supervise the Main Street program. That's perhaps the most controversial. According to your figures, 856 million in loans in the system, but it's a program that could do 600 billion in loans. Does that suggest modifications need to be made to the Main Street program?
Well, I'd highlight we've already made quite a few modifications. So we had an initial term sheet. We came out with a revised term sheet, and then it was revised once again to make the program broader and more accessible to a wider range of small businesses. We've also opened it up to the nonprofit sector. While we're not live on that part, banks are perfectly able to start the negotiations with the nonprofits. As you know, it takes a long time to actually negotiate a bank loan. So it doesn't surprise me that we would start gradual and that it would pick up over time. And so I think that's exactly what we're seeing. One reason we're seeing a lot of the lending coming primarily from community banks and mid-sized banks is they're probably a little bit more flexible and are able to adapt more quickly. I would expect that larger banks over time will start using the facility more. And the goal is to make sure that businesses that actually need it, that are creditworthy in February, that have had their cash flow disrupted, and are likely to be viable businesses after the pandemic is over, are able to get that kind of cash flow financing. And I think we are seeing a pickup in that activity. I expect as borrowers and as banks get more familiar with the program, we'll continue to see increases.
Well, that was the Boston Fed President Eric Rosengren. Now, coming up next, Sarah House, Wells Fargo Securities senior economist. Just a couple of things to talk about in the markets. So we're looking forward to that interview. That's coming up shortly. And this is Bloomberg.
illustrate just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. Two of JCPenney's biggest landlords reportedly may buy the chain's retail business out of bankruptcy. According to Dow Jones, Simon Property Group and Brookfield Property Partners have teamed up and are in advanced talks. The two are seen as the leading contenders. Dow Jones says they've offered concessions over lease agreements for Penny's stores. Meanwhile, Lyft posted its worst financial performance as a public company. The ride-sharing business reported a 61% decline in revenue, and Lyft's loss rose by 37%. Still, both numbers were better than expected. The company maintained its forecast for a quarterly adjusted profit by the end of this year. And Apple has a $44 billion market in China. It's now threatened by President Trump's executive order that prevents U.S. businesses from doing business with WeChat. That's the app that has become integral to everyday life in China. One Hong Kong resident says the WeChat ban threatens to turn iPhones into expensive electronic chat. That ban takes effect in roughly 5 weeks. And that is the Bloomberg Business Flash. Fran, Lisa.
Corinne, thank you so much. Economists at Wells Fargo Securities say global growth is looking mildly more positive. They point to momentum in Europe, China, and Canada, but not all economies are on the upswing. Well, joining us now is Sarah House, Wells Fargo Securities senior economist. Sarah, great to have you today. Now, I like the way you put the U.S. overview, which is a riddle wrapped in a mystery inside an enigma. What are you expecting from job numbers?
Well, I think in terms of the continuing claim numbers that we'll get today, I think we'll see another tick down. So when we look at the week that this covers, so this is the continuing claims cover the week ending August 1st. The new jobless claims are the first week of August. And we did see new coronavirus cases begin to fall over that period. Positivity rates flatten out. And so there's hints that the virus situation is at least looking a little bit more stable. And we think that the jobs market is going to follow that closely. And so we are expecting to see some further improvement in terms of the jobs situation, but the pace of that improvement is going to be much more mild than what we've been seeing over the past couple months.
Sarah, when do we know if some of these lost, or these jobs that have been lost are actually permanent? How long does it take for that to really take hold?
Well, I think it still could take some months to come. We're still in the initial phase of the bounce back, and so we've seen some really strong numbers out of the industries that have been hardest hit, like leisure and hospitality. But I think that's the big risk for the jobs recovery going forward, is that really the longer the crisis continues, is do you start to see some of the jobs weakness spread over into other industries that maybe weren't initially hit. So perhaps some of the more white-collar industries, as we're seeing pressure on companies' bottom line, so that's going to impact jobs at the corporate level, even those that can safely work from home, as just companies are trying to better control their labor costs. And so I think that's really what we're going to need to be watching in the months ahead, is that composition of job growth, where you're seeing some of the strongest increases, or alternatively where you're seeing job growth actually stall in certain industries.
In the meantime, we're seeing gridlock in Washington, D.C. They aren't getting together to come to any sort of deal for another round of fiscal support. Are we looking at a policy error here?
So I think we're certainly at risk of...
We close position on euro at 118.33.9. Profit, £500.
Needle much when you compare it to what Congress can do. So we think that there's still a good chance that you get some sort of deal, but right now there's really not that crisis moment that I think Congress is trying to stave off. I think they're getting some conflicting signals in terms of how desperately the economy needs some additional stimulus when you look at where markets are, and even the fact that you are seeing the job market continue to improve. So while we're still 13 million jobs short of where we were in February, we did see almost 2 million jobs added last month, and so I think that's taken some of the fire out of Congress to maybe get a deal done very soon. We think that maybe it gets wrapped up in the budget negotiations that we'll need to see done by the end of September. So we still don't have a budget for fiscal year 2021, and so that might give an opening for some negotiations.
Well, Sarah, let's say that they don't come to a deal by September 1st. How much does this negatively impact your expectations for U.S. growth?
Well, I think it really puts consumers in jeopardy. So we saw consumer spending what really led the downturn in the second quarter, but we're also looking for it to lead the bounce back. So quite impressively, we've seen personal income is actually up 4% relative to where it was at the start of the pandemic, just because that fiscal response has been so strong. But for many consumers, you weren't able to really spend it when you had the shutdowns in full force in the spring. So there is some pent-up demand, which has been propelling consumer spending. But if it looks like we can't get something done, or the degree of support is going to be much more modest, I think you could see a pretty substantial weakening in consumer spending as we look out over the remainder of the year. So even seeing those the supplemental unemployment insurance benefits go from $600 to $400, that's equivalent to about 1.5% of monthly personal income. And so we really do risk a potential drop in spending that's going to be very, very discernible.
Sarah, thanks so much. Sarah Hausler of Wells Fargo Securities. Now, in the meantime, this is what the markets are looking at. So the markets are looking at the stimulus package in the U.S., not seeing anything for the moment. So maybe the rally that we saw yesterday is fading somewhat, not only when it comes to U.S. futures, but also when it comes to European stocks. Also, what I'm hearing out there is after so many disappointments for riskier stocks, it seems that a lot of strategists on Wall Street should probably be forgiven for warning clients that the market rotation might not last. There's a great story on that by our Justina Lee, of course, of Bloomberg News. Now, coming up in the next hour, we talk about the stimulus. We talk about the Biden-Harris ticket with Jason Furman, Harvard Kennedy School professor and former chairman of the Council of Economic Advisors during the Obama administration. So we'll talk that. We'll also talk about, some of the things that we've talked in the Apple story, certainly when it comes to technology. And it's very clear when you look at the dynamics that Apple's $44 billion China market could be threatened by what President Trump is trying to do with WeChat. So we'll see the repercussions of that. We'll talk tech and retail. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The Boston Symphony Orchestra presents BSO at Home.
While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Sky high, the S&P 500 shoots above its highest ever closing level before finishing a few points shy of the mark. The rally hits pause today. No compromise. Democrats and Republicans point the finger at each other. The two sides remain trillions apart on a relief package. We'll hear from Jason Furman, the former chief White House economist, this hour. And Boston Fed President Eric Rosengren says over-eagerness to reopen the economy without containing COVID-19 has backfired for the United States. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacco here in London. Lisa Bravenitz stepping in for Tom Keene in New York. Lisa, not a quiet day in August. We have the markets to talk about. We look at stimulus. We look at the employment figures in the U.S. and, of course, the world of politics.
Well, 2020 isn't a normal year, and this isn't a normal August by any means. And part of this is that nobody can get away for vacation, or most people can't, for fear of having to quarantine for 2 weeks when they get back. But Francine, really focusing on the labor market, people talking about the improvement, but we cannot forget how unusual it is for more than 1 million Americans every week to be filing anew for jobless claims, and that's going to be our focus in about 2.5 hours' time.
Yeah, and that has huge implications also for further, permanent job losses and actually what that means for the fabric of the U.S. economy. Now, we'll have plenty more on that throughout the day. Let's now get straight to the Bloomberg First Word News. Here's Karina Mitchell. Hi, Karina.
Fran, good morning. Joe Biden and Kamala Harris gave a preview of what the fall campaign may sound like. They made their first joint appearance as Democratic running mates, and they tore into President Trump for his failed response to the coronavirus pandemic. The event could end up being one of the few times the running mates actually campaigned together. Pandemic restrictions have limited Biden's in-person events. Meanwhile, President Trump can make his nomination acceptance speech from the White House lawn or executive residence. That's according to a government advisory opinion. Generally, U.S. government